In the freight and logistics industry, margins are tight, payment cycles can stretch for weeks, and cash flow is the oxygen that keeps companies moving. Whether you're a small freight broker matching loads for a few trusted carriers, or a large 3PL managing hundreds of shipments daily, financing plays a critical role in keeping operations steady. When the Federal Reserve makes a move on interest rates, the ripple effects reach far beyond Wall Street. In this video, we'll discuss how, for the freight sector, those effects can directly influence factoring rates, broker borrowing costs, and even how quickly carriers get paid. And with the Fed now signaling possible rate cuts later this year, the freight credit landscape could be in for some significant shifts. We'll first dive into the Federal Reserve's current position and why it's important. As of August 2025, the Fed has held its benchmark interest rate at 4.25 to 4.5%, the highest in over a decade. However, softening inflation data, slower job growth, and global trade headwinds, especially new tariff measures, are prompting speculation of cuts. Recent statements from Fed officials point toward at least one rate cut by September, with the possibility of two by year's end if economic conditions weaken further. For freight companies, this is more than a macroeconomic headline. Rate changes can directly impact the cost of financing day-to-day operations, accessing credit, and mitigating payment risks. Next, let's look at why interest rates directly affect freight finance. In freight, very few transactions are paid in cash at delivery. Shippers may take 30, 60, or even 90 days to pay their invoices. Brokers often advance funds to carriers well before receiving payment themselves. This gap between delivery and payment is where financing solutions like factoring or lines of credit become essential. Factoring companies provide immediate cash in exchange for invoices, charging fees that reflect their own cost of borrowing. Banks and lenders adjust interest rates on business loans, credit lines, and equipment financing based on the Federal Reserve's actions. Carriers and small brokers often rely on quick pay programs that are influenced by how expensive it is for their partners to access capital. When the Fed cuts rates, it lowers the cost of capital across the board, creating the potential for reduced fees and more favorable payment terms. Now let's dive into the impact on factoring rates. Factoring is one of the most widely used financing tools in the freight industry. A factoring company purchases a broker's or carrier's receivables, providing upfront cash and assuming the risk of collecting from the shipper. Factoring fees are directly tied to the factor's cost of capital. Now, when interest rates fall, a few things happen. Factoring fees may decrease, making it more affordable for brokers and carriers to convert receivables into working capital. Advance rates could improve with factors willing to release a higher percentage of the invoice up front. Competition among factors may heat up, as lower rates give them more flexibility to win clients with better terms. However, a rate cut won't automatically erase credit risk. Factors still evaluate payment history, credit reports, and industry trends before approving invoices, meaning brokers with poor credit profiles may not benefit as much from reduced rates. Next, we'll explore the impact on broker borrowing costs. Brokers often operate on thin cash flow margins, especially when scaling operations or entering new markets. Many rely on business lines of credit to cover operational expenses, term loans to invest in new technology or hire staff, equipment financing for trailers, trucks, or office upgrades. When the Fed cuts rates, monthly debt service costs drop, freeing up funds for reinvestment. Loan approvals may increase as lenders see a lower risk of default in a lower rate environment. Refinancing opportunities open up, allowing brokers to replace high interest debt with lower cost options. For brokers, this is an opportunity to reduce financing costs while improving liquidity, two factors that can boost both operational resilience and creditworthiness. Now, the impact on carrier payment cycles. Carriers are often the most sensitive link in the payment chain. Even a short delay in receiving payment can disrupt their fuel budget, payroll, or maintenance schedule. Lower interest rates can indirectly help carriers. Brokers and shippers may pay faster when their own cost of capital drops. Quick pay programs become more attractive if financing those payments is cheaper. Reduced factoring fees can encourage brokers to advance payments to carriers sooner. That said, payment cycles don't always improve automatically. Some brokers may hold on to the liquidity advantage to strengthen their own balance sheets rather than accelerating payments. Now, it's important to mention potential challenges despite rate cuts. While a rate cut sounds positive for freight finance, there are still headwinds that could limit the benefits. 1. Tariff impacts on trade flows. Higher import costs could slow shipment volumes, offsetting any financing relief. 2. Persistently slow-paying shippers. Some companies extend payment terms regardless of interest rate conditions. 3. Credit risk from economic uncertainty. If a rate cut signals a weakening economy, defaults may actually rise. 4. Tighter factoring criteria. Factors may use the breathing room to focus on higher quality receivables rather than loosening standards. In short, lower rates can improve the cost of financing, but they can't fully insulate the industry from payment risk. And finally, some tips on an action plan for brokers and carriers. If you're in freight, here's how to prepare now for the potential Fed rate cuts. First, review your financing agreements. Know the terms and whether your lender or factor adjusts rates automatically. Second, shop for better factoring terms. Use lower rates as leverage to negotiate fees or advance rates. Third, lock in refinancing opportunities. Reduce debt service costs before rates potentially swing again. Fourth, strengthen your credit profile. Ensure your credit report accurately reflects your payment history to qualify for the best terms. And fifth, build cash reserves. Use the savings from lower borrowing costs to create a buffer against slow-paying customers. And now, where TransCredit fits in. Rate cuts can help, but only if your credit reputation positions you to take advantage of better financing and payment terms. This is where TransCredit's credit management and protection program gives brokers and carriers a competitive edge. With TransCredit, you can monitor your credit profile 24/7 to ensure factors and lenders see your most accurate payment history. Dispute and resolve inaccuracies that could limit your financing options. Submit references to keep your profile strong and current. Track your score and days to pay trends so you can act before small issues become costly problems. A lower interest rate environment is the perfect time to strengthen your position with shippers, carriers, and financers. And TransCredit gives you the tools to do just that. In conclusion, lower rates, higher opportunity, if you're ready. An interest rate cut can be a welcome tailwind for the freight industry. Lower factoring fees, reduced borrowing costs, and potential improvements in payment cycles all help create breathing room in a business where every dollar counts. But the benefits aren't automatic. The companies that will gain the most are those that pair a lower cost of capital with a strong, credible credit profile that lenders, factors, and carriers trust. With uncertainty still looming over trade flows, tariffs, and economic growth, preparation is key. By combining smart financing moves with TransCredit's credit management tools, brokers and carriers can navigate the coming rate changes with confidence and use them as a springboard for growth in 2025 and beyond. Thanks for tuning in, and we appreciate you for watching. Visit our website at www.transcredit.com to review all the ways TransCredit can help. Don't forget to like, comment, and subscribe to our YouTube channel @TransCredit, and we'll see you on the next one.